So you're welcome back, my dear professional students. In the previous video, we read this question from the beginning to the end. Now we want to look at it again and start extracting the salient points and be showing them in our workings, which will lead us into solving this question. So let's go and start again from the beginning. Let me clean all of this. Okay. So I have the question. Now this question says that Unitarization PLC is a successful Nigerian company which recently amended its object clause in the Memorandum of Association to include programs and activities that will promote national unity and encourage anti-terrorism compliance as part of its social responsibilities. The company therefore acquired 60% of the equity share capital of Famous PLC, a widely known and successful advertising company, to propagate this mission, and were given the summarized statements. Now, in this first paragraph, what is important there is that Unitarization PLC acquired 60% equity interest in Famous PLC. And because the acquisition of equity interest is above 50%, this resulted in Famous PLC becoming a subsidiary of Unitarization PLC, which also prompted the preparation of consolidated statements. And we are faced in a question which requires you to prepare consolidated statements. The first thing you must do is for you to establish your group structure. It is very, very important. So the first thing we're going to do is we're going to determine our group structure. So we have our workings here. So the first one here will be our group structure. And in there, we have Unitarization PLC, acquired equity interest of 60% in Famous PLC, this is the group structure. And when you identify the group structure, the next point of note to identify is the date of acquisition. And of course, you know that since Unitarization PLC acquired 60%, that means the non-controlling interest will be 40%. Then the second point is the date of acquisition. You need to determine the date of what? Of acquisition. So, what is the date of acquisition? We're not given in this first paragraph. So, let's go on to our question. Okay, so we go to the additional information. In the additional information 1, they said the shares of Famous PLC were acquired on 1st May 2014. And the issue of shares, okay, was not recorded by Unitarization PLC. So what we need right now is the date of acquisition, which is 1st of May 2014. So the date of acquisition is 1st of May 2014. That is the date of acquisition. Having determined the date of acquisition, then you will determine also the date of consolidation. And the date of consolidation will be given in the requirement of the question, which is the date you are required to prepare the consolidated statements. Or in the statement, they must have given you in the question the date on them and the date of consolidation. Here is what I'm saying. you will see that we were given the statement of profit or loss for the year ended 31st October 2014. That is the date of consolidation. Statement of financial position as at 31st October 2014. That is the date of consolidation. And if you look at the requirements of the question, the statements we were required to prepare all were at 31st October 2014. So the date of consolidation is 31st October 2014. No, not December, October. Abi? Yeah, 31st October 2014. Now, look at these two dates very closely and tell me what your observation is. Okay. If you look at it very closely, you will see that we acquired the subsidiary 1st of May 2014. However, the date of consolidation is 31st October 2014. You should note here that this is a scenario of an acquisition of a subsidiary during the year. You must be able to identify that at the very beginning of the question. It is extremely important you identify that. The date of acquisition and the date of consolidation will give you a pointer to whether this is an acquisition during the year or not. Because if you should miss that particular point, if you don't identify that the question you are solving is a question of an acquisition during the year, you might get very little mark in that question. So please, you need to be able to identify that. Having identified that, then we go back to our question. We have looked at additional information 1. So, let's move on with reading the additional information. Let me clean all of these notes. Okay. Now, back to it. So, we have determined the date of acquisition. And we're told that the issue of shares was not recorded by Unitarization PLC. We will get there, we'll see what they are talking about. So that, because we are telling you that it has not been recorded, that means you need to record it. We will get there. And also, additional information too. We're told that there is a cash in transit of 120 million due from Unitarization PLC to Famous PLC arising from intragroup trading. A cash in transit is a cash that has been sent by an entity to another, but which has not been received by the other entity. Then that is a cash in transit because it has been sent, but it has not been received. So we were told that Unitarization PLC sent money to Famous, but Famous has not received it. What I can tell you for now is that whenever you have cash in transit in a question, whether it is given directly this way or in some other ways, if it's given directly this way, you need to know that cash in transit must be consolidated in a question. Must always be consolidated. Now, let's move on to the point 3, which is the additional information 3, which says that the non-controlling interests are valued at full fair value. Are valued at what? At full fair value by the parent company, which is Unitarization PLC. And we were told that the fair value of the non-controlling interest in Famous PLC at the date of acquisition, we were given the value as 3,540 million. Okay? So we have the value of the non-controlling interest as 3,540 million. I think we should note that down. NCI at fair value. NCI, which is the non-controlling interest, at full fair value. And I would like to present my figures the way the question presented its figures. So they rounded it to million. So that means I will have 3,540. If I add millions, which is 6 zeros here, I will still get 3,540,000,000 as given in the question, like this. Where is it? Here. Okay? I want to advise you to start writing this in full in your workings. You might get confused and all. So what I advise you to do is the way the statements are presented. You see that the statement is presented in millions. And all these figures are summarized. You get? That's how you should present it in your solution also. It makes things easy for you. Okay. So now, this question told us that NCI is measured at full fair value. I'm sure by now you should know that NCI could either be measured at proportionate share of subsidiaries' net assets, or it could be measured at full fair value. In this case, it is measured at full fair value, and the value was given to us in this question. And they also told us that there is no goodwill. There is no goodwill impairment at the end of the accounting period. Now, the next additional note, which says that the fair value of Famous PLC's assets were equal to the carrying amount at the date of acquisition, except for one equipment with a fair value of 1,200,000,000, okay, over its carrying amount, which has a 5-year remaining life and the straight line depreciation is adopted, and Famous PLC has not effected the adjustments in the records. Now, what this additional note is directing us to is a situation where there is a fair value adjustment. Usually, according to IFRS 3 on business combinations, whenever a parent entity acquires controlling interest in another entity, the parent is required to carry out due diligence by determining the fair value of the identifiable assets and liabilities of that subsidiary. And in doing that, there would be differences between the fair value of those assets and their carrying amount. That difference will result in a revaluation surplus or a loss. And that is the situation here. But in this case, we were told that the fair value of the subsidiary's assets, which is Famous PLC, they said they were all equal to the carrying amount at the date of acquisition, except for one equipment with a fair value of 1,200,000,000 over its carrying amount. That points us that this 1,200,000,000 is a fair value surplus, or it is a fair value reserve, because it is an excess amount over the carrying amount of that equipment. It is a what? An excess amount over the carrying amount of that equipment. Okay? So this is a scenario of a fair value adjustment which arises at the date of acquisition. And they now gave us the remaining life of that equipment, and they told us the method of depreciation. So how do we adjust for this? So let's go to our workings to adjust for the fair value adjustment. So that will be workings 4. So our workings 4, I will have a fair value adjustment and I'll put it in millions. And this fair value adjustment was on an equipment and the excess amount as given in the question is 1,200,000,000. 1,200,000,000. So it will come out like this. You get? Now, because this is an excess amount over the carrying amount of that equipment, therefore, we are saying the carrying amount of the equipment should be increased by this amount of 1,200,000,000. So we're going to increase the carrying amount of this equipment by that amount. Therefore, we're going to add this amount to the asset, which is the equipment, and also the corresponding entry. Where will it go? If you say cash, you're very wrong, because we did not buy this equipment. If you say other payables, you're very wrong, because we did not buy it on credit. We did not buy it at all. What happened is that we carried out a fair value exercise. And that fair value exercise resulting in determining a fair value which was higher than the carrying amount, which led to us having a fair value reserve. Whenever that situation arises, the corresponding entry for that increase in equipment or for the increase in the item of non-current asset, the corresponding entry will be a revaluation surplus account or a fair value reserve account. Either one is fine. So here we can choose to put it to fair value reserve account. Now, this equipment, we're going to add this value to the equipment. However, this fair value reserve is a pre-acquisition reserve because it's a reserve that is arising at the date of acquisition. Because this fair value adjustment was carried out at the date of acquisition, therefore, this fair value reserve is a pre-acquisition reserve, which will be cancelled out on consolidation. Because pre-acquisition reserve are not consolidated. They are cancelled out against the purchase consideration. You will see it when we get there. However, for this equipment, because we were told in the question that the subsidiary, who is Famous PLC, had not recorded it in its books. Therefore, we need to add the 1,200,000,000 to the equipment. And since we are just adding it in this current reporting period, that means there will be an additional depreciation that has also not been considered. So what will be the additional depreciation? So we are going to have an additional depreciation. And how do we determine the additional depreciation? The question will give you the useful life of the asset, or they will give you a depreciation rate. If they don't give you those figures, there is no way you would be able to determine the additional depreciation. However, this question gave it to us. This question gave us the remaining life of this asset as 5 years. This is it. 5 years remaining life. And he told us that straight line method of depreciation should be adopted. And he said he has not effected these adjustments in the records. So now, since we know that the remaining useful life is 5 years, so we can determine the annual depreciation and the annual depreciation will be the cost of the assets or the revalued amount or the excess amount. In this case, what we have is the excess amount. Let me put my millions here, okay? Which is 1,200,000,000 all upon the remaining life of 5 years, okay? And I need you all to bring out your calculator, please. If you don't have a calculator, go and look for a calculator. You need to follow me. You need a calculator to follow. So let's do 1,200,000,000 divided by 5 years. That gives us 240 million. However, this 240 million is per annum. But from what we identified initially, we identified that the date of acquisition was 1st May 2014 and the date of consolidation was 31st October 2014. Therefore, this excess amount of 1,200,000,000 had only been in existence or had not been recorded for only this period from May to October. And that's how many months? So the post-acquisition period is only 6 months. You need to count your hands, please. Don't assume you know mathematics. You could make mistakes. So we're going to count it from May, June, July, August, September, and October. That's 6 months. Therefore, this additional depreciation will be adjusted only for 6 months. Therefore, in 2014, we are going to adjust only for 6 month depreciation, which will be 240 million, multiplied by 206/12, which is the same thing as saying 240 all upon 2, and that gives me 120 million. And that is the additional depreciation. This additional depreciation of 120 million, how do we adjust for it in the consolidated account? Depreciation is an expense. And usually you deduct depreciation in the statement of profit or loss as an expense. So you debit depreciation expense and you credit accumulated depreciation, which will be deducted from the cost of the asset. Therefore, for this additional depreciation, we're going to deduct it from the retained earnings of the entity that owns these assets, who is the subsidiary. So we deduct it from the CRE of the subsidiary, who is Famous PLC. And also we are going to deduct it from the item of property, plant and equipment. You deduct it from the equipment. The 120 million. And this is how you adjust for the additional depreciation. And that is it for these notes. In the next video, we are going to look at the next notes. But please feel free to watch this video over and over again so that you learn how to make a fair value adjustment. This is how fair value adjustments are reflected in the consolidated account. These are the adjustments necessary. Please go over it over and over again before you proceed. In the next video, we will look at the next additional information. Thank you very much. See you in the next video.